We are Group 20. Our project is titled The Impact of RBA Monetary Policy Decisions on AUD Exchange Rate Volatility. Below are our 5 members. We have divided our presentation into 5 sections. Now, please welcome our first member to
My name is Ke Zhang. I will talk about the literature review. Let me firstly introduce our objective and the methodology. This study examines how the Reserve Bank of the Australian monetary policy decisions, especially interest rate adjustment, affect the return and the volatility of the AUD divided USD exchange rate. We identify abnormal returns within specific event windows and test their statistical significance. We also analyzed how external factors such as US dollar index and gold futures influence this result. Methodological, we used an event study combined with market model and interest rate change factor, controlling for the US dollar index and gold prices to isolate the effect of the RBA decisions. To contest our approach, it is essential to review some literature. This started by Koch and Brooms in 1990 was the first to systematically validate the event study methodology in foreign exchange market. They compared for abnormal return models and found that the market models performed best in identifying abnormal movement around policy event. This contribution established the foundation for extending event study analysis from equities to currencies. Building on their approach, our report applies the market model-based framework to examine how the Australia dollar responds to RBA announcements. By controlling for external factors like the US dollar index and gold prices, we can better isolate the specific influence of RBA decisions on short-term AUD divided USD returns. Building on the event study framework validated by Koch and Brooms, we also drawn from Almeida and Armier 2021 study, which applied EGARCH and asymmetric extensions such as EGARCH and EGARCH to capture exchange rate volatility, coloring, and leverage effect. Their finding shows that a EGARCH 1.1 model best explained asymmetric volatility response to shocks. Following this approach, our report uses EGARCH model to estimate conditional volatility in AUD returns and to construct abnormal and cumulative abnormal volatility. By combining event study and volatility modeling, the analysis reveals that RBA policy decision trigger short-term volatility spikes, yet the market quickly stabilizes afterward, reflecting strong transparency in Australian monetary system. And these are reference.
Hello everyone, I'm Annie. I will cover our data selection, data cleaning and alignment, and the testing and validation steps. Our goal is to ensure a clear sample definition and a fully reproducible pipeline, and to use statistical tests to establish that RBA decisions significantly raise short-term AUD volatility, then deliver directional and level forecasts for November, December. First, data selection. we build an events plus factors framework around AUD/USD. On the price side, the sample spans the 10th of January 2024 to the 29th of October 2025 with 472 trading days and 421 observations after cleaning. We use AUD/USD, EUR/USD, GBP/USD, and USD quoted pairs, USD/JPY, USD/CAD, USD/CHF, USD/CNY. To keep home currency appreciation equals positive, we invert USD quoted FX. So for factors, we include the US dollar index, DXY, and gold futures. On the policy side, we use the change in the RBA policy rate, missing values set to 0. Next, data cleaning and filtering. We harmonize date and column names across sources, align all series to the shortest common span, and drop any rows with non-finite values. For event study at daily frequency, we work with simple return, percentage change, keeping the sign convention. Home currency appreciation is positive. For monthly work, we construct month-end closes and compute monthly log returns used in volatility modeling and forecasting. For forecasting on the event side, we keep only significant events, encode buy, sell as plus or minus 1, and weight event strength by the absolute value of cumulative abnormal volatility multiplied by the signal-to-noise ratio. We then aggregate by month to obtain the net signal, capturing the net long, short, tilt in that month. In our volatility analysis, the key event is the RBA rate cut on the 18th of February 2025, with March 2025 taken as the event's center month. In the event study design at daily frequency, we use an estimation window of 55 to 6 days, a main event window of 5 to 5 days, and a comparison window of 2 to 2 days. For event significance, we combine 4 tests at the 10% level, the traditional t-tests, the standardized t-tests, the rank sum tests, and the bootstrap p-value. This ensemble approach improves robustness and reduces reliance on any single test. For volatility diagnostics, we use 6 classes of tests: Lyon box tests on residuals and squared residuals, the EGARCH LM test for remaining EGARCH, sign bias, and joint tests for asymmetry, the Niblom parameter stability test, and the Pearson goodness of fit test.
I'm Maverick, and I'll talk about our modeling and forecasting framework. We combine an event study method with a EGARCH volatility model, and finally using a multivariate regression to forecast the relationship between RBA interest rate changes and the Australian dollar exchange rate fluctuations. We start with the event study model, which measures how RBA policy announcements affect Australian dollar and US dollar returns. The market models serve as our base regression, linking currency return with market factors. The extension model introduced additional explanatory variables, such as the US dollar index and gold, to control for external macroeconomic shocks. To ensure our data is credible, 4 tests are used: t-test, standardized residual, sign rank, and bootstrap. Next, we modeled the volatility dynamics and conducted the conditional variance equation. This allowed us to dynamically predict future risk levels. We also calculate the actual and abnormal volatility. If abnormal volatility is positive, which means the actual volatility exceeds the model predictions, this indicates volatility amplification. And if it's less than 0, the market is relatively stable with volatility below expectations. We build a conditional log likelihood, sum it over time to obtain the total log likelihood, and pick parameters that maximize it. We also employ robust standard error to enhance the reliability of t-test. What's more, we also construct anomalous volatility. If the negative value indicates how much actual volatility is different comparing with the expected volatility. Positive AV means amplification, while the negative one implies subdued volatility. Summing AV within event window use cumulative AV. Our window is centered on 1 March 2025 within 5 months, allowing us to access short-run and cumulative impact of the RBA decision, especially around the rate cut.
Hi, I'm Xingtong. Thanks to Maverick's explanation of the project model and predictions. Next, I will share our project analysis results. Our research mainly focuses on the impact of Australia's interest rate cut in February 2025 on the Australian financial market, particularly on the yield and the volatility of the Australian dollar. And first, we used the event study to measure the market reaction to the RBA monetary policy announcement. The abnormal return and the cumulative abnormal return within the event window are calculated using the market model. The event window is said to be 5 days before and after the daily announcement. The research results show that approximately 20% of the trading days have significantly abnormal returns, indicating that the RBA's monetary policy announcement had indeed caused market fluctuations. The CAR value fluctuate approximately between negative 7.7% and 6.1%. Among them, the reaction in March and April 2025 is most obvious. The stage after the policy is implemented. When we compare the two different windows events from -2 to +2 and -5 to +5, we find that the CAR curve jumps significantly at t equals to 0 on the announcement day, and continued to rise in the following days. This indicates that there may be a phenomenon of some information reacting in advance in the market. At the same time, investors also need some time to fully digest policy information after the announcement. Through t-test and rank sum test, we also verify that the volatility during the event window period was significantly higher than that in the normal period, with the p-value almost being 0, and the results were highly significant. The results show support for resolution information leading to the increase and aggregation of short-term fluctuations. And next, we analyze the volatility behavior of the market after policy changes. We use daily Australian dollar earning data to estimate the EGARCH 11 model and adopted the t-distribution to capture the variation in field variance. The model estimation results show that the beta coefficient is close to 1, indicating that the fluctuation shock has shown persistence. That is to say, the market fluctuation will not immediately subside after being impacted. Subsequently, we compare actual volatility with conditional volatility predicted by the model. The difference between the two in abnormal volatility, AV, and the cumulative abnormal volatility within the time window is further calculated. It was found that the abnormal fluctuations is most sample period when negative, indicating that the actual market volatility was lower than the level predicted by the model. However, after the interest rate cut, especially in April 2025, the abnormal volatility was briefly positive, indicating a slight loss of uncertainty in the market. However, on the whole, CAV is equal to negative 0.082, which means that the overall volatility within the entire event window is still below the normal level. In other words, the market smoothly absorbed the shock of the interest rate cut and restored stability in the short term. This is in line with the statement that uncertainty will decline after the resolution is implemented. All in all, the RBA's policy announcements did trigger short-term price and the volatility response, but this impact was short-lived and limited. The Australian foreign exchange market demonstrated strong resilience and stability. And next, leave the time to my groupmate Link, who will further explore the reflection and the implementations of these results.
Hi everyone, this is Link Hong here. Now let's move on to the discussion part. The main takeaways from our investigation is that the EGARCH mode performs strongly in explaining and forecasting exchange rate volatility, especially in uncertain policy environments. Among different volatility models, the EGARCH captured the key features most effectively: persistence of volatility and potential asymmetry in market reactions. Even though the labor's term, gamma, was not significant, the model still produced stable and realistic forecasts, showing that the Aus dollars and US dollars markets quickly adjust to the new policy information. One key insight we learned is that a model that fits the data well does not necessarily have the best forecasting power. So, good in-sample performance does not always translate into strong out-of-sample accuracy. This tells us it's important to strike the balance between model complexity and predictive reliability, particularly when working with short-time series like ours. To conclude our presentation, our study shows that gauge class models are not only useful for modeling volatility, as previous research mainly stressed, but they can also provide meaningful insights into how exchange rates react to monetary policy decisions. Specifically, the EGARCH with the student distribution successfully captures the persistence of volatility and the slight asymmetry in the Australian dollars and US dollars markets. However, our analysis has some limitations. We focused on only one mode and a relatively short sample period. In future research, we plan to test additional GARCH-type models such as EGARCH, iGARCH, and VGARCH, which might perform better, especially in highly volatile environments. In summary, our findings indicate that RBA monetary policy announcements do create short-term volatility, but markets tend to stabilize quickly afterward, reflecting the effectiveness of the RBA's communication and expectation management. Thank you very much for your listening, and we look forward to your questions and feedback.